Hey everyone, welcome to Tax and Accounting Tips, short videos designed to get you a bigger tax refund, protect you from loss, or just give you peace of mind that if the IRS comes a knocking at your door, you've done things right. Being audited by the IRS is scary, but fortunately, it's also unlikely. Generally, the odds of this happening are less than 1%. Still, there are certain items the IRS considers red flags, which can trigger an audit. Here are some of the leading triggers. One is neglecting to enter the income on your tax return that was reported for you to the IRS by third parties. That income reported to the IRS has to match or be lower than the income that you reported on your tax return, obviously. That means if you receive tax forms like a W-2 from your employer, a 1099 from your stockbroker, or Social Security, or even from your favorite casino, you should make sure that the income is included on your tax return. Those 1099 forms usually come out in late January or early February, and forgetting to enter them on your return is one of the most common reasons for an audit. Another tip is that many experts believe that filing your taxes closer to the deadline makes it less likely to be audited. That assumption is that the returns selected for audit are done on a first in, first selected basis. No one has proven this is true, but filing closer to the deadline might tilt odds in your favor. Another thing to be aware of is that the IRS does compare tax returns from one year to the next. Be aware that unusual fluctuations in amounts entered could be a red flag. A major change in business income tax deductions are notorious for triggering audits, and taxpayers who include personal expenses as business expenses could incur severe penalties. To avoid this problem, make sure you only claim legitimate deductions. Don't run personal expenses through your business. If you do, you're asking for trouble. Now, if your legitimate business deductions are excessive compared to your business income, it could still result in an audit. Bottom line is, if earning too little or too much may trigger an audit, but there's really nothing you can do about it in either situation except be prepared. If your income is very low or even negative, or it's very high, the IRS may pick you for an audit. Make sure your deductions are valid and properly supported. Commonly examined deductions include bad debt expense for businesses, casualty losses, home office deductions, large medical expenses, business travel, meals and entertainment expenses, hobby losses. Did you know that if you have losses in a business more than 5 years in a row, that can trigger an audit, and as part of the audit, the IRS can deem the business a hobby. And if they do, all those business deductions that you've took during the last 5 years could get thrown out, and you would end up owing quite a bit of money in back taxes. Another common audit trigger is if you amend your tax return and you fail to attach the information the IRS requests to support the change. If you don't, the IRS could send the return back, which will delay your refund, and it could lead to an audit. Finally, while you can certainly round to the nearest dollar for consistency and accuracy, avoid rounding to the nearest $5 or $10 mark. That makes your numbers look too perfect, and the IRS computer may assume that you're making the numbers up. So, even if you are audited, there's really nothing to be worried about as long as you keep your records and fill out your tax forms accurately. However, if you are facing an IRS audit and need assistance, we are here to help. We're also happy to answer any questions you may have about your tax return or the audit process. Thanks, and have a great day.